Right. Well, welcome everyone to tonight's webinar. I know it's 5 p.m. Thank you for joining us. I know that we have some attendees that are still logging in, but we will go ahead and get started with the presentation. Christy, I know that we wanted to do a little bit of an introduction for Marshall Reddick and everything that your organization brings to the table, and then I'll come back in with the use it or lose it. The countdown to year-end tax planning begins, and we'll talk a little bit about how people can wrap up and wind down 2023. But first, I want to take the first couple slides and hand it over to Christy. It's a pleasure to be hopping on the digital platform with you today.
Thank you. Pleasure to be on with you as well. We are here with Marshall Reddick today, offering you this free online event. And who's Marshall Reddick? We are a real estate brokerage company, property management, private money lender, and investment fund. Marshall Reddick has been around since 1979, and I've been with Marshall Reddick since 1996. So we make it possible for everyone to be able to purchase residential real estate all over the United States, and specifically selected areas that we're in. And we provide you real estate brokers, contractors, property managers, and just access to all the top people in the industry, including today's presentation and Tony from our accounting firm that we use, our CPAs. So just a little bit about myself. I moved to Los Angeles in 1996, and I grew up in Sarasota, Florida, originally from Chicago, and I graduated from Florida State University with BS and BA degrees. And while I was working out in the music industry here in LA, I found Marshall Reddick teaching a course at Santa Monica College, and I started taking all his classes and his club meetings and free education in 1996 as an investor. And after purchasing many properties in 2000, I became a realtor, a real estate advisor, and an educator for Marshall Reddick, and have purchased 22 properties. And I've been a realtor myself for over 23 years and have sold over 500 properties. And I have extensive experience advising and working with builders and developers and multiple investors on project managing jobs. I'm a single parent. I have 2 college-age kids, Harrison and Olivia. One's at UC Santa Barbara and going on to law school, and the other one is just starting at Pierce College. So I'm an avid volunteer for animal rescues, and I have 3 dogs, 2 of which are rescue dogs from the streets. So Marshall Reddick's offices has a national footprint. We have boots on the ground offices in the Bay Area and also in Los Angeles, of which where I'm located in Woodland Hills. So we have Orange County, Riverside. Then we also have 4 offices in Texas: New Braunfels, San Antonio, Austin, and Houston. We have offices outside of Nashville in Clarksville, Tennessee. Then we also have an office in Cape Coral. So how do we choose the areas we invest? We have multiple things we look at, but some of the most important things is the job market, the vacancy rate, the economic diversity of the area, how affordable the housing is it a landlord-friendly state, which is extremely important, that like in Texas and Florida and Tennessee, you can get a tenant out in 2 weeks. Also the strong education areas, do they have universities around? Also reliable property management, which we have our in-house property management that makes everything just go seamlessly and smooth. I'm going to let Tony take over from here, and go ahead, Tony.
Awesome. Thank you so much, Christy. You know, one of the things that I really enjoy about working with Marshall Reddick's network is that as a real estate investor myself, when my brother and I first started investing in our properties and kind of ventured into the wonderful world of real estate investing back in 2007, those were the things that we were looking for, you know, towns where there were universities and things being developed. And so when we landed in Austin, Texas, with our first few investments back in 2007, 2008, through a 1031 exchange out of a property in San Luis Obispo. We realized, just like we had kind of run our own property management little business up in San Luis Obispo, renting out rooms in our homes to our friends and our other students at Cal Poly, and then I transferred to Chapman. I did the same thing down in Old Town Orange. Is that was where the gold was lying. We needed properties around universities, and we have their parents co-signing on their lease agreements. And let's face it, it's either their parents paying for their rent if they're college students, or it's their student loans paying for their rent. So, we've had a lot of success in developing our real estate portfolios around campus areas. And I know that Marshall Reddick, since I had known Marshall Reddick from 2 decades ago, when I first met Marshall at a little lunch meeting that I had with him, I realized that our two organizations work very well together, because I'm very pro real estate from an income tax standpoint. And then also most, if not all of the employees with Marshall Reddick across the US, they're all very well versed, not practicing in the tax code area like I do, but they're very well versed in the real estate side of investing and how that could potentially end up being a really nice tax shelter. So Christy, thanks again for sharing the digital podium with Robert Hall this evening. Today's topic, wealth retention through proper year-end planning. I'll tell you, this is probably the most important time for United States taxpayers to set aside some time in their busy schedules to sit down with their tax consultants and just map out a plan to wind down 2023, really to position themselves in a more powerful place to help retain wealth and not overspend when it comes to paying the federal and the state tax obligations. Let me go ahead and there we go. Oh, I went one too far. Just a little bit about me. I'm going on almost 2 decades with the firm. I am not only an enrolled agent, a tax practitioner. I represent my clients in front of the Internal Revenue Service. I prepare roughly around 1,200 tax returns per year, and I'm also the keynote speaker for our firm. In my individual column of clientele, I think my clients roughly range in the $500 million in managed real estate and other business dealings. And then on the education side, for the public speaking side of what I do, I am the keynote speaker for over 140 plus both digital events, webinars, and other digital kind of educational platforms, as well as in-person seminars. So if you're ever in need of further education when it comes to tax sheltering through real estate syndicated investments, long-term rentals, property flipping, Robert Hall and Associates, we do offer all of our education for free. So you can check our website out, roberthalltaxes.com, to learn about more of our upcoming events. I by no means am a one-man operation. I work alongside a wonderful senior consulting staff. We service as a firm roughly around 12,000 tax filings per year. We've got about 55 employees working for the firm, very much still a family-owned firm. Bob Hall started this organization back in 1971. And has grown it into a very well-known organization across all 50 states. We actually can file taxes in all 50 states. In fact, I think that currently out of the, all of the states, I think we have clients actually in 45 plus states, maybe actually now in all 50 states. But if you have investments outside of California and you have questions about how to file in other parts of the US, feel free to reach out to us. We do offer free consultations. Once again, we service well over 10,000 filings. We've got great reviews online. We've been recognized by local favorite account, or in the local news ads, Glendale News Press, San Gabriel Valley Tribune, Los Angeles Daily News. And then we've also been interviewed by a lot of other larger organizations. So being open and up and running in business for over 50 years, obviously the Bob Hall name has become kind of a household name, at least in the Southern California area for the most part. We are not just a tax preparation firm, though. We do offer incorporating services. We do internal auditing, financial planning, bookkeeping services. We're kind of a one-stop shop for all of your financial needs. This is what Bob Hall dreamed up over 50 years ago. He wanted everything under one roof, and it has played out and led his business into being a very successful accounting practice over that 50 plus years. I will remind you about this towards the end of my presentation. We do offer free consultations. Best way to engage in our services for this free consultation is either to text Robert Hall to the number 72,000, or you can just call our office and you can find our information online. Best thing to do is send us 2 years of tax returns. Let us look at those returns, analyze them prior to the free consultation meeting. We'll check for any possible audit triggers on the return. And if you're not looking to onboard with a new accounting firm, at least sign up for the free educational webinars. But this is the best way to get on that email blast list, so you know about all of our upcoming educational events. Just as a note before we start, I am not an attorney. None of what I'm speaking about today is giving you any sort of legal advice. All of the advice today will be solely based on the Internal Revenue Code and the Secular 230, which is a rule book that us accountants have to follow in the tax consulting industry, where we try to stay in our lane of expertise and not step out of that lane and start giving any sort of legal advice. I will touch on a couple things that might seem like I'm stepping out of my lane, but anything legally speaking, you absolutely want to consult with an attorney before moving forward with incorporating it as any sort of entity. I am here really just to talk today about the income tax side of everything discussed today. Let me go to the next slide. Why is that not going now? For some reason, this is not going to, nope, went too far. Nope, that was the next one. Awesome. So let's get into the meat and potatoes. Why is it important for us to know our tax situation prior to the end of the year? I ask a lot of clients why they might think it's important to sit down with us in the fourth quarter of the calendar year. And I ask them, what do you think? What do you want to get out of this meeting? And most of them will say that, well, I'm planning ahead so I don't pay any unnecessary interest and penalties. And that's absolutely correct. We want to pay our obligation in tax and not a penny more than that obligated amount. So if you can separate some time towards the end of the year to map out a plan and really truly implement that plan and that strategy prior to the end of the year, you can truly hit your obligation or obligated amount in tax and not end up overpaying the government, because let's face it, where do you think the interest and the penalties are going these days? It might be going to funding new hires with the IRS. It might be going to funding a Humvee that's being blown up overseas. I mean, who knows where the government spends the money these days, but we want to make sure that we plan ahead to pay as little tax as possible while keeping most of the cash, if not all of the cash, in your bank account. And once again, just paying your obligation in whatever the federal and state tax liabilities are. The second answer I get mostly when I ask clients of what they think the importance of year-end planning is just positioning power. I want to position myself so that my tax return looks good when I submit it to a lender. I want to be able to qualify for the most that I can borrow so I can start my career in real estate investing. I want to make sure that I'm maximizing every angle possible, maxing out my solo 401k, my self-directed IRAs. I want to make sure that I'm making good financial decisions and helping me retain as much of my hard-earned wealth as I possibly can. Last but not least, probably the most important is just to give you peace of mind. People want to know what they're up against prior to the year even being over. Right now we're, October 26th today. So we've got a little bit over 2 months left in the calendar year. And imagine this, obviously most of us don't want to be able to tell the future, right? That's a little scary to think about, but imagine if you could see into the first quarter of next year and know exactly what your bottom line liability or refund is looking like. Well, that's where we get this importance of year-end planning from. We want to make sure that you know what your tax return looks like prior to the year even being over. And this is a very powerful position, and it gives you peace of mind knowing that you are doing everything you can to help further reduce that liability. So those are the three main points of year-end planning, keeping you in that power position and not entering into the end of the year, and especially in tax season, not knowing what's going on. I get this question a lot from my clients as well. Hey, do I have to prepay my tax over a quarterly basis? Most of you are either self-employed or active real estate investors. Some of you might also have spouses, or you yourselves might have a little bit of W-2 income. So you've got a couple different income sources. And your preparer might have printed out these vouchers for you with the 2022 tax filing, where you have to prepay your tax every single quarter as what are called estimated tax payments. And some of you might be thinking, well, I don't know how those numbers are calculated. Like, how is the accountant coming up with these figures? Because it seems like I'm paying way more this year than I was last year. I don't think I'm going to owe this much. I might be working less, or I might have sold something and my income spiked this year, so maybe I'm not paying enough in prepayments. Well, remember that the estimated tax payment schedule is meant to cover one of two calculations: either 90% of your current year liability or 110% of the previous year's liability. So there's a very unique calculation in this. And our software programs in the tax industry, when we print out these estimated tax payments, if we just let the computer system do its job, it's going to print your estimated tax payments out to be 110% of the previous year's liability. Well, obviously, if you only meet with your tax advisor to file the tax returns and then don't speak with the tax advisor until next tax season, and you're in the meantime making 110% of those payments throughout the year, and something happened where maybe you didn't work a quarter, or you didn't have a closing in the third quarter, or maybe somebody retired and had less overall income in a married filing joint scenario, well, obviously you don't have to make all of those estimated tax payments if there were significant financial changes in your individual financial world. And so we need to meet with our clients at least 2 to 3 times a year just to plan ahead and make sure that you're not overpaying the government. And the government would happily accept your overpayment and then wait 3, 4, 5, 6+ months into the new year to refund you that money. But as an investor myself, and a majority of my personal clients being investors, I know the power of having cash available in your account to really kind of pull the trigger on an investment when it comes across your desk or into your financial world. So once again, you got to make sure that you understand why those estimated tax payments are there, and whether or not the calculation is correct. 90% of the current year liability, 110% of the prior year liability. And when we sit down with our clients and map this calculation out, it's called a W-4 review. We need to make sure that you are not overpaying, that you are not underpaying, and we want to put you in that power position to not, or to pay your obligation in tax, but not overpay or not underpay where you're getting hit with unnecessary penalties and interest. So just be aware of that. This is most commonly known in the W-2 space, when someone in your household is a W-2 employee and they're withholding too much from a paycheck stub, or let's say they bought a home throughout the year and now all of a sudden they have this great mortgage interest and a property tax write-off. They've got large charitable contributions that might help them reduce their liability. Well, we need to change your W-2 withholding to account for these additional write-offs. It could work the reverse way too. Let's say you sold your primary residence at the beginning of the year and now you no longer have a mortgage interest write-off or a property tax deduction. Well, we need to increase your withholding to make sure that we're covering enough liability so you're not being assessed interest and penalties. So keep that in mind. As we approach year end, you're probably looking for some unique write-offs to obtain or to capture on your individual returns. And you know, the past four years, I mean, gosh, it seems like a lot longer than that because the pandemic seemed to be, you know, decades ago. But you know, it started in 2020 when the pandemic really shut down everything and people started changing things up, people exiting out of industries, people entering into industries. And we noticed that in 2020, 2021, and 2022, that people's expenses and deductions were changing as well. So I'm going to talk about some of the top tax deductions that you can maximize on your individual tax return and on your business returns prior to the end of the calendar year to help you further reduce some of this taxable income that you're going to be reporting. One very interesting thing that I noticed in 2020, 2021, and 2022 is that the clients who saw an increase, kind of forward and upward progression of income, there was one expense that also kind of went along with that increased revenue kind of situation, where the more income somebody was making, you look at their marketing and advertising costs and you saw the marketing and advertising expenses also increasing at the same time that the revenue was increasing. And I noticed that more so than ever in my 20-year career with Robert Hall, that during the pandemic, people were really pumping a lot of money into promoting their business practice, whether it be a rental property that had a vacancy and they were, you know, advertising on multiple rental property platforms. For the realtors, the real estate professionals in the US, they were spending a lot of money promoting their business, making sure that they were staying relevant in a time when people couldn't do door knocking. We couldn't go to in-person seminars and networking meetings where we could shake hands and hand out business cards. So I saw that marketing and advertising was a consistent expense that continued to grow, especially during the pandemic. And obviously that correlated with the increased revenue. This in particular is not only a great write-off because you're reinvesting profits back into infrastructure and allowing your business to grow and seek affluence in upcoming years, but it is also a dollar for dollar deduction against your income. So once again, if you have a rental property and there's a vacancy in that property, whether it's a 2, 3, 4, 10, 15, 20 unit building, it doesn't matter what size building or what size property it is, this is going to be a dollar for dollar expense to offset your rental income. It's a dollar for dollar expense to offset your commission income. Now, if you're a W-2 employee, more likely than not, you are not expensing out of your own accounts to market and advertise your business. Normally, that's your employer who spends that money. So marketing and advertising won't be a dollar for dollar write-off against W-2 income, but for the self-employed individuals and the rental property owners, this is always going to be a great dollar for dollar adjustment to taxable income, while once again, reinvesting your profit back into infrastructure, allowing yourself to expand your business and maybe reach other markets that you haven't tapped into. Perfect example is Marshall Reddick. You know, having multiple offices across the U.S., I can only imagine what their marketing and advertising budget is to reach the markets that they are in across the U.S. I believe that when I first met Marshall Reddick, he was only a one office operation. I know that he had investments elsewhere in the US, but I believe that it was only one office back in 2006, 2007. I might be wrong in that. But now look at the range of clients that they have across the US and all of the office locations that they have. So this is a big part of business development, and the government will allow you to write it off dollar for dollar against taxable income. One other expense during the pandemic I really saw absolutely explode were professional supplies and equipment. We're still continuing to see the work from home part of the US economy really grow and expand. In fact, Robert Hall & Associates, in its 50 plus years of business, we have never had remote workers before up until 2020, or we had never had workers up until 2020 that worked off-site. Now we have 3 or 4 employees that are remote workers. We have an employee who works in San Antonio, Texas. We have some employees down in Orange County that work remotely, and they sometimes come into the office, but this is just a new part, a new way of doing business in this beautiful kind of tech era that we're entering into. And I think that our hand was forced because of the pandemic. I mean, perfect example is Robert Hall & Associates. We were forced to shut down in-office operations for almost 2 years. The LA Health Inspector's office showed up to our office and asked our office manager, hey, listen, how many people do you meet with during tax season, Monday through Saturday from January through April? And on any given day, Monday through Saturday, we were seeing 110 to 120 warm bodies in our office every single day for 3.5 months out of every year. And so they said, absolutely not, we're not going to allow you to stay open. And so we had to switch over to the cloud platforms and be able to still connect with our clients digitally. So, you know, when I moved home out of my office, now I'm back in office, which is great. I'm sitting looking out at the Glendale mountains right now. You know, working from home, I had to upgrade my Wi-Fi, I had to upgrade my computer equipment, I had to upgrade my desk, you know, got one of those stand-up desks so I didn't sit for 19 hours a day during tax season. So all of those expenses ended up being great overall write-offs for the business. If you are self-employed or even a real estate property manager, you more likely than not have an allocated space inside of your house that has office equipment. One reason why I really, or actually a couple of reasons why I really like this deduction is, number one, professional supplies and equipment, it's going to be a dollar for dollar federal deduction against self-employed income. And number two, supplies and equipment has one of the lowest audit risks out of any expense on your individual and business returns. Think about this for a second. How many people do you know in your professional space who can do what they do day in and day out without a computer, without a printer, without a cell phone, without a mouse, without a tablet? You know, these are some of the most common business expenses in today's world. And so obviously the government understands this, and there is a much lower risk of audit. I'd say less than probably 1 or 2% audit risk on all of these items. Third reason why I really like these deductions is you have options of how to write them off. You go out and you buy this brand new $3,000 MacBook or computer station, and if you don't need the write-off this year, let's say you've already expensed all of your profit for the year and you're already showing a break even or maybe even a loss, and you still need this computer expense, so you go out and you purchase the computer. If you don't need the write-off this year, the government allows you to take this $3,000 computer and either deduct it all in 1 year if you need it, or spread it out over the lifespan of the asset. A piece of equipment has a 7-year lifespan. Office furniture has a 5-year lifespan. So you can either take it all in the first year. It's called accelerating the depreciation write-off. Section 179 of the Internal Revenue Code allows us to do that. Or you can spread the deduction out over the 5 or 7-year lifespan if you need it down the line. Now, let's say 2 years, 3 years down the line, now all of a sudden you're starting to show profit and you need the remaining portion of that deduction. You don't want to wait the full 7 years. You can actually accelerate the remaining depreciation in year 3 and take it when you actually need the write-off. So once again, professional supplies and equipment, great overall write-off. You just need to understand how you can write it off and what your options of how to write it off will be. Number 3, let's go. Okay. Car and truck expenses. During the pandemic, we saw a lot of change in the car deduction space. In 2020, because of the pandemic and the import-export issues that the US was having and the chip shortage with new vehicles and how that was really impacting the new vehicle market, the federal government said, hey, listen, because we're seeing all of these issues, we are now going to allow business owners to buy out their leased cars and convert that expense into a depreciable asset and accelerate the full buyout write-off as a deduction, which is really cool. See, prior to the pandemic, if you were leasing a vehicle and you bought out the vehicle, that wasn't a depreciation write-off for you. It was only the monthly lease payment that you were taking or spending, and you could only allocate a certain percent of that expense because if the car was being used for personal and business use, only the business use portion would be a deduction. But in 2020, when the government saw the writing on the wall about the slowing down of importing of new cars into the US, they said, hey, listen, don't worry about this. Used vehicles, we're going to give you the same tax benefit, the same bang for your buck. If you are looking out that front window and you see that leased vehicle sitting in your driveway, you can actually buy out that lease and convert it into a deduction as if you were purchasing a new vehicle. So we saw a lot of clients do that. We saw a lot of clients, saying, hey, listen, I really like the car that I'm leasing. Would it make sense for me to buy out that lease? And so we run the numbers from a tax perspective. And a lot of our clients chose to actually buy out their leased vehicles, converting that deduction into a depreciation expense, and then in some cases, fully accelerating 100% of that buyout as a dollar-for-dollar deduction. Now, you do have to be aware that the deduction really for vehicle purchases and acquisitions, it really all pertains to the weight class of the vehicle. If the vehicle weighs over 6,000 pounds, then you get something called accelerated bonus depreciation. If it weighs over 6,000 pounds, like the Chevy Tahoes, the Tesla Model X's, the Mercedes G-Wagons, even the Chrysler minivans weigh over 6,000 pounds. Back in 2020, if you were to buy out that leased vehicle, 100% of the depreciation value, 100% of the buyout would be a write-off because it was called 100% accelerated depreciation. If the vehicle weighed under 6,000 pounds, you were only allowed in 2022 an $18,200 write-off, and then the remaining value of the vehicle had to be depreciated over 5 years. Starting January 1st of 2023, the rules have changed a little bit. You no longer are allowed 100% bonus depreciation on the 6,000 pound or heavier vehicles. You are still allowed, though, and it's still a great write-off, don't get me wrong, but it's not 100%. You're allowed 80%, 80% of the total value of that heavyweight vehicle as a dollar-for-dollar deduction to offset self-employed income, or if you structure yourself correctly, against rental cash flow income. Still, if the vehicle weighs under 6,000 pounds, it's not 100%, it's not even 80%. It's going to be the first, I think, $20,200 in the first year, and then the remaining value of the vehicle has to be spread out over the lifespan of the asset, which is 5 years. Now, if you're not looking to acquire a vehicle or buy out a leased vehicle, you're probably taking the mileage write-off, which mileage at the moment is around 60 plus cents per business mile. Now, what does that mean per business mile? It means that out of the total mileage that you put on your vehicle throughout the year, you have to break that total mileage down into 3 buckets. You have your commuting mileage, you have your personal mileage, and you have your business mileage. Commuting and personal mileage, not a tax write-off. But for real estate professionals, for active investors, normally a greater chunk of the mileage is business mileage. And at that point, let's say that you have 20,000 miles, you got 5,000 for personal, 5,000 for commuting, and 10,000 for business mileage. At that point, you get roughly about a $6,000+ write-off based on the 60+ cent deduction per business mile. So have these conversations with your tax advisors. Make sure that if you are a taxpayer who is looking to buy out their lease or maybe even shopping for a new vehicle, that you acquire it, that you title it, that you insure the vehicle in the correct way to allow yourself with this great accelerated write-off, okay? Number 4, legal and professional fees. I'll tell you right now that prior to the pandemic, a lot of individuals, including W-2 employees, were able to write off their tax preparation fees, their attorney fees, their trust and administration fees. All of these legal and professional fees were great overall write-offs. And in 2018, under the tax reform bill that the Trump administration had passed, they got rid of a lot of expensive deductions for W-2 employees. And around that time, when we were having conversations with our clients, everybody thought that no one could deduct legal and professional fees anymore as deductions. But it really was only the W-2 employee taxpayers that were no longer allowed these as write-offs. The self-employed individuals, the real estate investors, the people who file Schedule E's, Schedule C forms, 1120 S corporation returns, LLCs, partnerships. If you have a business or a rental property, there is still an itemized line item on your return that allows you to deduct legal and professional fees dollar for dollar. So make sure that you're also working with a tax advisor who understands what you specifically get to deduct and what others might not be able to deduct. That's a really great, really large, powerful position for you as self-employed individuals and real estate investors to take. This is a deduction that you get to take, but not every taxpayer is allowed on their returns. So keep that in mind. Number 5, last but not least, bonus depreciation. We're not talking about bonus depreciation on the vehicles anymore. We're talking about bonus depreciation on rental property investments. Prior to the pandemic, every year or so, I would probably have 2, 3, maybe 4 clients elect something called cost segregation on their returns, but it wasn't a commonly known deduction for investors. And all of a sudden during the pandemic, when we switched over to the webinar platforms for our educational kind of based presentations, we started talking and coaching people about, and coaching them about cost segregation. And our webinars, our in-person seminars used to pull in maybe 30, 40 people a seminar. And then when we started doing webinars where people could watch and educate themselves at home, sitting in their boxer briefs on the couch and learning rather than having to drive all the way to Glendale to listen to some crazy tax guide speak about the tax code, there was a lot more interest in education during the pandemic, especially on the tax side of things. And so I started doing a lot of webinars specifically around cost segregation. And for those of you, I know that we have a small group tonight, but for those of you who know what cost segregation is, great. I'll briefly kind of break that down for you. For those of you who don't know what cost segregation is, cost seg is the ability to take the value of your rental property, the building itself, not the land, but the building itself. And instead of waiting 27.5 years, or for residential, 39 years for commercial, instead of waiting all of those years to receive the depreciation write-off of the building, cost segregation allows you to tell the government, hey, I don't want to wait all of those years to get this write-off. I'd rather take a good chunk of that all in one year, offset a ton of my rental property cash flow, maybe even show a loss to offset taxable income elsewhere on my return, and take the benefit now. And with all of that tax savings, I'm going to take that tax savings, I'm going to buy more real estate. And then next year, I'm going to do cost segregation on the new properties that I acquire. Otherwise, the government requires you to take the building value of a residential property and write the building asset off over 27.5 years, for commercial over 39 years. So essentially, you're accelerating future year deductions to help save you tax now in the current year. And with all of that tax savings, hopefully you're not going out and spending it on things that aren't making you money, like buying a new Porsche or something. You want to cycle all of that tax savings into buying more real estate. And that's where we bring Marshall Reddick into the picture, and they show you what they have in inventory and what's possible out there across the US and other states. And that's how we really capitalize on that. And then once you close on that new property, guess what? You talk with your tax advisor, we do another cost seg election on that property, we accelerate the depreciation, save the tax in that year, and then take that tax savings and buy more real estate. Like I mentioned earlier in my presentation, I'm very pro real estate. That's why I work very well with organizations like Marshall Reddick, because I know time and time again, not only as a tax professional, but also as a real estate investor, that real estate, whether the economy is good or bad, people will always need a place to live, number one. Number two, real estate is always the greatest tax shelter for your money. That's number two. And number three, real estate always has the greatest exit strategies, meaning that let's say that you bought a property 30 years ago, it's fully depreciated, you've made all the improvements that you possibly can make to the property, and you bought it for, $100,000 30 years ago, now it's worth $2 million. With property, you can, instead of selling it and paying the tax on it, you can do 1031 exchanges with the property and take that one Southern California home worth $2 million and exchange it for 30 rental properties or 30 doors elsewhere in the US and defer the complete capital gain tax in that exchange. So once again, real estate through and through is always the best opportunity to build wealth, especially when you are trying to build legacy wealth, to leave for your next of kin, to leave for the generations to come, while paying very little income tax because of all of the great tax sheltering benefits through real estate investing. Christy, do you have any comments on this? Any key points that you can point out? Maybe you've seen this professionally in your career, how people take their tax savings and they use it as down payments on new homes, so on and so forth. Have you seen this before?
As far as taking tax savings and using it for down payment, yes. Well, one of the ways you could do it is if you know that you are going to pay a certain amount in taxes that's going to be coming back to you because of the write-off, is you can save that tax savings in a savings account earmarked for a new property. That's one of the ways you can do it. And then another thing I was mentioning when I was hearing you speak, I just didn't want to interrupt, is I've purchased 22 properties through Marshall Reddick. I still have 11 of them. And I literally have not paid any income tax since 1998. I don't pay federal, state, Social Security, nothing, because I have so many write-offs with all my rental properties. I always explain to someone, let's say you own your owner-occupied home and you get $10,000 write-off. Well, imagine if you own 10 homes, that's $100,000 write-off. You actually get even more write-offs with rental property than you do with an owner-occupied home. So, and people say, well, you're not paying into Social Security and this and that. And I'm like, well, what do I care about a whatever amount Social Security payment when I'm building millions of dollars in real estate equity and also over time the equity. So I do myself I do multiple things with tax advantage, like take money out of one property to rehab another property, and then take money from that property and rehab another property, and then I'm selling one in Hawaii now, and I'm 1031ing into a property in Texas, a duplex, and a house in Sarasota, and I bought the property first in a forward exchange. So it's like you learn over time how, and that's another way to, not have a tax consequence. I've learned over time how to use equity in my properties to make more equity, and how to save tax savings from properties to buy more properties, if that makes sense.
I love it. Great points, Christy. Yeah, and I read an article back in 2016 about this Social Security issue that the government was having, because more and more people are self-employed, and the self-employed business owners can offset all of their profit with expenses and essentially pay very little, if nothing, in Social Security tax. And so this article back in 2016 said that the government actually projects by 2032, and I don't know how recent or how accurate this data is now, but they had projected that by 2032, Social Security would be all dried up. It's like the theory of the water well, right? Or better yet, a bank account, right? A bunch of people are contributing and people are taking it out, and for a while that worked, but now there are too many people collecting Social Security and not enough people paying in. So what happens to that bank account? It eventually has a zero balance at the end of the day. So for those of you who have paid into Social Security already, from what I understand, that is secure, but eventually that Social Security benefit will dwindle down and the government will have another plan in place, I assume. But yeah, by 2032, and I'm right there with you, Christy, about building exponential wealth in real estate assets that you have control over, rather than something that the government manages for you. That is always a scary thing when you leave it up to the government to manage assets. You know how they spend money, you know how they lose money, you know how aggressive they are when they try to collect things from the US taxpayer. So this is something that is really, really a powerful point to make. Thank you for pointing that out, about building exponential wealth in real estate, and really really having a control over your retirement, which is now in equity and other assets in cash flowing investments. So great point on that.
Yeah, and one of the things I want to mention too, and you might have something to say on this as a CPA for sure, is like on my, I took money out of my Nashville property, my Clarksville property, to rehab my Hawaii because I knew I was going to be selling it to buy 2 more, and I didn't want, you never want to use your own money, right? And so I'm doing that, and when I do my exchange, I'm spending about $50,000 with expenses and rehabbing the property. So I'm going to do a boot on like $50,000 of the 1031 money. Now I realize capital gains boot is different from rehab money write-off. But the point is I have enough write-offs that I can wash the boot and pay myself back for the money that I paid in rehabbing, if that makes sense.
That's
Maybe
right.
you
That's
might
right.
want to elaborate on that.
Yeah, and when you have an exchange that has boot, for those of you who don't know what boot is, it means that you didn't exchange the full capital gain into a new property, and so you're actually tapping into some cash out of the exchange. You're absolutely right. With proper with proper strategizing in place, and implementation of that strategy, you can essentially improve other property which shows enough deductible loss or expense to offset some of the boot that you have through the partial exchange. A full-blown exchange is where you defer 100% of the capital gain. An up-leg exchange is when you actually exchange from your $1 million property into a $1.8 million property, so you're carrying more debt on the new property. This boot scenario is when you go from like $1 million property into a lower value property, so you're accessing some cash out of the exchange and you're using that to improve other properties, so on and so forth. But once again, those improvements on those other properties, especially if you elect cost segregation, that can be a direct offset to any capital gain or boot that you have out of this exchange that wasn't a full exchange. So yeah, great points to make, and these are all powerful positions for you to take as United States taxpayers alongside the proper advice from a tax advisor. You got to have these conversations and try not to navigate the rough waters of the tax code by yourself. I've run into scenarios where clients have come in during tax season and said, hey, Tony, you're really going to be excited. I exchanged this property last year. I now am owner of this new property elsewhere in the US. So what are my tax returns going to look like? And I said, well, I don't see any exchange paperwork in your documents. And they say, well, I actually sold the property. I took the money into my personal account and then I bought another property. I said, well, unfortunately, that doesn't qualify as an exchange. What qualifies you for an exchange is that you can never actually touch that money unless it's on purpose, right? Unless you're trying to take boot from the exchange. But if you don't go through an exchange accommodator where they set up a trust account to receive the funds from the sale and then they transfer it into escrow on the new property, all of a sudden that becomes a taxable transaction because you didn't actually go through the necessary steps to exchange the property. So once again, have these conversations with your tax advisor. It's very important for us to be involved in that step-by-step process, okay?
Yeah, and I just want to say really important, something I just learned, because just like what you said, Tony, I don't use Tony as a CPA, but I've used the same CPA for over 18 years. And I work very closely with my CPA and my accommodator, which is our accommodator, Dino Champagne, with asset preservation, Marcia Reddick uses. But I learned something very big the other day, Tony. At first, I was just going to have the title company in Hawaii give me the $50,000 and send the rest to the accommodator. But then what would have happened is they would have taken withholding tax out in Hawaii out of my whole amount, out of the $50,000. So now I've learned through the CPA and the accommodator, you have to take all the money, send it to the accommodator, and then designate how much you want going to the properties you're buying and how much you want to keep. And that way you avoid paying withholding tax in a particular state you're selling it.
Yes, and every state is different. So you got to work with CPAs and EAs that understand the different tax codes across the US states.
Yes.
Great point. Yeah, and talking about deductibility of mortgage interest, over my 20-year career here at Robert Hall, I've had some silly questions come across my desk, and I don't mean them as being silly questions, because no question is a dumb question, no question is a silly question. It's just people don't know. And so I've had clients say, well, should I opt for a higher interest rate to give me a greater tax write-off? And that is never going to be the case. You never want to opt to pay more points. You never want to opt to pay a higher interest rate solely because of the tax savings, because what you pay $1 in interest is not going to save you $1 in tax. Always remember that. Now, when you talk about a primary residence versus a rental property, the mortgage interest deductions are different. They weigh heavier on your return under a rental property than a primary residence. Back in on December 15th of 2017, the federal government passed a new rule under the Internal Revenue Code that stated that if you purchased a property after December 15th of 2017, you are only allowed the interest deduction on a primary residence and a second home, not a rental property, but a second personal residence. You are only allowed the interest deduction on the first $750,000 of acquisition debt. So if you have a primary and a second personal residence, something that you use personally as a second home, you get $750 in debt deduction on the first property, you get $750 in debt on the second property. But on a third, fourth, fifth, personal property that you own, unfortunately, that all becomes investment interest and it's not deductible as mortgage interest. Now that's on the federal side. California never conformed to that part of the Internal Revenue Code. So on the state side, you're actually still allowed the interest on the full first $1 million of acquisition debt, which was the rule prior to December 15th of 2017. So clearly on a primary residence and a second personal residence, you are limited on the amount of interest deduction that you can take. Whereas a rental property is a business. Right? Businesses get to dollar for dollar deduct business expenses. So when you have a rental property that has a $3 million loan on it, guess what? The rental property investment can fully dollar for dollar deduct all of the interest expense because it is a business. There is no limit to the mortgage interest write-off. There's no limit to the property tax deduction. There really is no limit across the board on your rental property expenses. But on your primary residence and a second home, once again, you got to understand some of these thresholds. It's not the Wild West where you could just throw 100% of the interest on the return. You have to know about some of these limitations. Outside of the mortgage interest, there's also a limit on your property taxes since 2018, where the max state and local tax deduction, which includes your property taxes on the federal and state side, is only $10,000. So there are some workarounds for self-employed individuals who have in-home offices where we could take a larger allocation of those expenses. But once again, I got to redirect it all back to sitting down with your tax advisor and mapping out a plan and knowing what you are limited on and what you are not limited on. I saw a lot of individuals during the pandemic turn their primary homes and their second homes into rental investments. And then they moved elsewhere, maybe moved into one of their rental properties that had lower interest, and they started renting out their primary residence or the second home. So these are all great strategies and conversations to have and talk about with your tax advisor. So keep all of that in mind, okay? Retirement, as we approach the year end, a lot of us are looking to maximize our deferred comp plans. And for the real estate professionals and real estate investors that I have in my own clientele roster, a lot of them don't really have much faith in the stock market these days. And if you are a stock investor like I am, I dabble in multiple investments, but the tech sector and a lot of the stock market, just really hasn't been returning a whole lot of gains like we had seen during the pandemic, obviously, when everybody was at home and everybody thought they could be day traders, and Zoom stock was through the roof, and a lot of these other stocks were just booming and people were making a lot of money. Well, the stock market could adjust overnight, literally while you're sleeping, through dark market trading and all of these other things that happen on the stock market side. But I don't know if you all knew this, but since 1974, you have also had the ability to diversify your retirement investments into retirement accounts called self-directed retirement accounts, known as the self-directed IRA, both Roth and traditional. So you could do a self-directed Roth IRA, you could do a self-directed traditional IRA, or you could do the 401k module, which is solo 401k or solo Roth 401k. Now, what does this mean? Instead of investing in stock investments through these self-directed retirement accounts, you can actually buy real estate in your retirement account. You can buy businesses in your retirement account. You could also buy stock in your retirement accounts under a self-directed IRA or a solo 401k, but you can diversify your investment portfolio while enjoying the tax-free growth in the retirement account, or if you have a Roth, the tax-free growth under a Roth, or you can enjoy the tax-deferred benefit under the traditional solo 401k or self-directed IRA. But this has been around for a long time. 1974, that was a long time ago. And only over the past, I'd say 10 years have our clients at Robert Hall really started to fully grasp the power behind this. We had been mentioning it to people, but they're like, oh, well, the stock market, it's something that I'm hands off, and my brokers are doing a great job. We're making good 5-6% return on our money, which is fine. If you want to stay long-term conservative in your retirement investing, that's fine. Some people are just want that long-term conservative benefit. But if you are looking to shake things up and really invest in things that you truly believe are the powerful investments, like myself as a real estate investor, I dabble in a lot within my retirement accounts. Sure, I've got the brokerage accounts and the retirement accounts with stock, Google and Tesla, and I've got a bunch of stuff over there. But then I also want to make sure I'm maximizing the real estate angle on my real estate on the retirement account side as well. So keep this in mind. This is a great conversation to have with your tax advisors about what you can do, especially if you're in retirement. And I'll give you a quick example. I had a client who worked for Northrop Grumman for probably 35, 40 years, and he had always been interested in real estate, and he had bought a couple rental properties here and there while he was working. And when he went into retirement, he left with a 401k or a pension of some sort with over $2.5 million in it. Now, when he left, he still kept quite a bit in the retirement account with Northrop, but he diversified his portfolio. I think at the time he pulled out $1 million from the retirement plan, rolled it into a solo 401k, and started investing in real estate syndication, started acquiring small businesses, doing short-term loans, and he's really been able to capitalize on his retirement portfolio. And last time I spoke with him earlier this year, I think his overall value, net value in his retirement is somewhere around like $8 or $9 million, which it just shows you the power behind diversifying your retirement portfolio investments. So keep that in mind. Have this conversation with your tax advisors. One last important thing I want to get to before we open up for Q&A is the importance of basis. And if we were talking 5 years ago and doing a seminar 5 years ago, I probably wouldn't even touch on this. But during the pandemic, the federal government introduced, or didn't introduce, but highlighted a form that has always been there called a 7203 basis form, form 7203. And this is really important when you are trying to shelter losses through real estate investments to offset other income on your individual return. I have a lot of clients investing in real estate syndications. I have clients investing in ATM businesses. I have clients investing in a whole kind of range of different investments these days. And so, and some of them are being told that, hey, you invest in this business, we're going to accelerate some write-offs, and you're going to have a $100,000 write-off that's going to help you save tax because of certain games they're playing through the investment vehicle. Well, understand that in order to take that $100,000 loss, you have to have basis in the investment, meaning that you've either had to capitalize the investment with your own fund, with your own funds, equal to the loss, meaning that in order to take the $100,000 loss, I had to invest $100,000 in the business, or I had to put $20,000 into the business and carry $80,000 of qualified non-recourse debt or recourse debt. Non-recourse debt does not increase an investor's basis. And I don't want to confuse you about all these terms and whatnot, but just understand that if you are talking to investment professionals about greater investments to help shelter taxable income, you have to understand the rules behind taking those losses. There were only a few, I'm not going to say a whole lot, probably 3 or 4 investors in 2023 when we met for the 2022 tax preparation meetings that didn't meet the qualifications to take these losses, and they were incredibly bummed out by not being able to take it. But and we found other vehicles through cost segregation to help them save tax and whatnot, but they had been sold up the river on the fact that if they invested this money, that they were going to be allowed this massive loss adjustment to W-2 income or to other self-employed income, but the basis qualifications were not there. So if you are that investor who's looking into diversifying outside of real estate and you're plugging money into the syndicated market where you're pooling funds to buy a bunch of real estate across the US and you're like a 2% owner of the syndication, or if you're investing in an ATM business and they're telling you that they're going to accelerate the equipment deduction and you're going to have this massive loss, just understand that before you invest in that, have this conversation with your tax advisor, make sure that it all maps out and that you truly will be able to receive that massive tax sheltering benefit when it comes time for personal tax filings. Basis is incredibly important in today's world because, like I said, during the pandemic, the federal government really put a very thick microscope over the basis form on individual returns and on company returns. Okay, so I don't, once again, that's probably a whole 4-hour seminar just in itself, but I did want to briefly touch on that topic before we went into questions. I'm going to leave this this slide up here. This is the best way to engage with our firm in a 30-minute consultation. Like I said, if you're not looking for a new tax advisor, that's fine. At least send the information over so we can link you up with our marketing department to let you know about our upcoming free educational webinars. If you're tech savvy and you've got a smartphone, you can open up the camera and just point the camera towards the QR code at the bottom right screen. It'll pop up a link that you can click to submit your information for that free consultation. But I think, Christy, now's the time to do a little bit of Q&A. If anybody has any questions, there is a question box that's part of GoToWebinar. Please put your questions in the questions box, not the chat box, and that way we can record the questions. And if there's something that's more complicated that warrants kind of a consultation with Christy or with Robert Hall and Associates, we can guide you to the free consultation. But if anybody tonight has any questions, go ahead and type those questions into the Q&A box. I know that it's getting late too. If anybody needs to jump off, thank you so much for attending tonight. Keep our information, reach out to Christy if you have any questions on the real estate side. But now if you have any questions, go ahead and shoot with the questions. And sometimes we actually don't have questions because people would rather sit in a more personal setting and ask those questions. And like I said, there's no silly questions. There's no dumb questions. You ask us the questions that you think, even if you think, oh my gosh, this is something illegal. Ask your tax advisors what you are capable of doing, because we are here to assist you and kind of navigate the road to proper tax planning and proper tax structuring. I've had clients ask me some questions where I'm like, wow, where did you hear that question from? And there's YouTube videos online, there's Instagram, there's TikTok videos. I mean, people are going all over the internet for education these days. And a lot of times that advice is not coming from a licensed advisor. So you just have to be very, very careful where you are getting your education from these days. I can't stress that enough. Some of my new client consultations will come in with questions about these TikTok videos that they've seen. And I said, well, it's not 100% correct, and it's not 100% not correct. Like we need to kind of dive into whether or not real estate professional elections were made on the return, whether or not the active participation rules kick in, whether or not the basis information is met or the qualifications are met. So, I'm not saying that you just ignore the education, because I'm very happy that you're out there educating yourself, but you do need the proper advice from a licensed professional, somebody who understands the code and what is possible at the end of the day. It doesn't look like anybody's typing in there, but Christy, if you have any other closing remarks, please take it away. And yeah, thank you everybody for attending, and thanks for having me.
Yeah, I just want to thank everyone for attending as well. And I just want to say, like, don't be fearful of the tax situation. Just like you taking any of these classes, the most important thing is education. And literally your accountant, Robert Hall and Associates, or if you use a different accountant or whoever you use, they are your lifeline, and you should always bounce back and forth between your CPA, your accommodator, even your Marsha Reddick advisor. If you need any help from me, you can reach me. I'll give you my cell phone. We don't have a slide, I don't think, right now with my information. Normally that's supposed to be there. But my information, my cell phone is 818-694-0740, 818-694-0740, Christy Dietz. And I'd be happy to answer any questions as well. If you have any, obviously, any tax questions, go directly to Tony here at Robert Hall, and he can answer anything there. But it's definitely, the more you do it, the more you learn, and you definitely need a team of people to help you do it, but it is relatively easy if you have the right people in place.
Couldn't have said it better myself. That's a great comment there. It's not difficult. It is a lot of work, but if you have the right advisors in place, it doesn't have to be like the nightmare stories that you sometimes hear. I mean, I've had clients say, I'm never investing in real estate again. And I said, well, why? That's silly. And they go, well, I've heard all of these nightmare stories about tenants in Southern California. And sure, I have a number of nightmare stories I could bend your ear with, but at the end of the day, the success stories heavily outweigh the nightmare stories. I could tell you that. after filing, thousands of returns over decades of my career, tens of thousands of returns, I can give you 100 success stories to every one nightmare story. And I'm sure Christy could do the same. So build your team around you, build your team of professionals, and we are absolutely here as resources for you if you ever have any questions.
Yes. Well, thank you so much, everyone, for coming, and we'd be glad to help you and assist you in anything that you need.
Thanks, Christy. Everyone have a great night.
Yes, excellent night.